One of our commitments to you is to ensure you receive a total wealth plan if you'd like one. When doing a total wealth plan, one of the main objectives is often to determine whether your financial assets are sufficient to last your entire lifetime. To determine this, we make several conservative assumptions. For example, we must choose a conservative assumption for life, which we model to age 95. If you've accumulated significant financial assets, your total wealth plan may project that your assets far exceed your projected spending during your lifetime. In this situation, any assets that are not spent during your lifetime and that have increased significantly in value will create a tax liability upon your passing. If you are married, this tax bill occurs when the second spouse passes away, if assets are jointly owned with rights of survivorship. A couple of examples could be appreciated real estate other than your principal residence, as well as your private company shares. A large tax bill that your estate must pay means that less of your estate can go to your loved ones. However, if you plan early, you may have the ability to minimize the impact of this tax bill and maximize the amount you leave to loved ones. A strategy we use to target a future tax liability is participating whole life insurance. The basic idea is that money you contribute into this life insurance policy can build up and grow tax-free within the policy. Depending on how the policy is structured, you may be able to pay up the policy over a defined period, such as 10 years. After the defined period, the policy continues growing over time and is essentially earmarked for your future tax liability. The amount of insurance we target is designed to match your projected tax liability at your life expectancy. Done correctly, the policy grows and the tax-free compounding does most of the heavy lifting. On the last spouse to pass away, assuming a joint last-to-die policy, the death benefit, which includes the built-up cash value, pays out tax-free to your intended beneficiaries. This ensures your beneficiaries receive what you intended, and the money is not eroded by payments to Canada Revenue Agency. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can both read past and current articles in the Greenard Index section. Thanks for listening.